So tBTC is both a decentralized permissionless Bitcoin bridge and a synthetic Bitcoin asset that is collateralized by Bitcoin deposits one-to-one. I'm sure you're familiar with wrapped Bitcoin, which is essentially like a tokenized IOU. You send your Bitcoin to some custodian. They issue you a tokenized representation on the Ethereum blockchain or whatever other blockchains that they might support. And you can use that to participate in DeFi. And that's effectively what tBTC is as well in terms of use case. But tBTC replaces that single centralized custodian with a network of signers that are collectively custodying that Bitcoin.
This podcast is sponsored by Coin ATM Radar. When buying crypto with cash, an ATM is much more reliable and safer than meeting some random person in a random place. And unlike an exchange, which could freeze your account, you truly own all the crypto you buy. With Coin ATM Radar, you could find crypto ATMs and other services where you can buy and sell cryptocurrencies for cash. On their website, you can search by coin, address, if the ATM supports selling as well as buying, and you can also search by geo area, country, state, city. You can also check and compare actual current fees at different ATMs. If you want to find out more, head over to coinatmradar.com, which is coinatmradar.com. Hey everyone, I have the wonderful pleasure of speaking with the one and only MacLane Wilkison today. How's it going, man?
It's going great. Thanks for having me.
Yeah, thanks for being on. As I mentioned, my friend Mark Hopkins was kind of what turned me on to you. I think he was talking a lot about Threshold, and it seemed to be an interesting thing in the space of just so many different projects that seem to be attempting similar things. But he's, as a fountain of information, I kind of felt like his shill was something I had to take seriously. So, it kind of hooked us up, and then here we are. So, would you mind?
Awesome.
Mind talking to the folks at home, as it were, about who you are and how you got into crypto?
Sure. So my name is MacLane Wilkison. I've been in crypto for, I guess by crypto standards, kind of an old man now at this point. Originally got into Bitcoin and Ethereum kind of pre the Ethereum ICO back in, I think, 2013 or 2014. And the context was I went to this SF Bitcoin developers user group, which was down in actually South Bay, not technically in San Francisco. And at the time, it was at this place called Hacker Dojo. I think there were like 5 or 6 of us, like max, that would attend these meetups. And it was me, Tom Ding, who was one of the later founders of Dfinity, Zucky, one of the early team members and contributors to Cosmos, and Michael Legorov, who I ended up starting NuCypher, which has since become Threshold with, and also he's now the founder of Curve. So in retrospect, like a very small but very interesting group of people that went on to do a lot of interesting things in crypto and blockchain. And since then, I've just been mainly working on NuCypher, now Threshold. Since then. But have been doing like a lot of mainly in like the threshold cryptography space, which sort of piggybacks very well, I think, ideologically and practically with blockchain. And we've been able to do a lot of very interesting things over the past 10 or so years, building in and around crypto.
Yeah, for sure. It's definitely the class of 2013, which I'm kind of 2013 as well, kind of that early era. It's kind of surprising to see how many people are still involved from that time, but it's like a surprisingly quiet group of people sometimes who just are holed away somewhere building, and then you're like, oh, you're still here. You're here from all the way back then. A lot of like the louder flash in the pan people kind of are gone maybe from that era, but it is kind of interesting to see that whole perspective from the early days. So tell me a little about NuCypher and kind of what is it and how did it turn into where it is today?
Yeah, so NuCypher was the project that Michael and I started, and basically the genesis of it was we met at this Bitcoin developers users group. We were exploring basically just a bunch of different ideas in Bitcoin and blockchain. At the time, Ethereum had not launched yet, so we couldn't build on Ethereum. But there were some, obviously it was sort of generating a lot of ideas about what might be possible beyond just like the use case of digital money and digital gold using blockchains and smart contracts. And so we were doing a lot of stuff, back then, like there were these protocols from meta protocols on top of Bitcoin, kind of like Counterparty and Mastercoin, that added a little bit of functionality. So
I did use Counterparty back in the day for some random shitcoin.
We were toying around with those and like doing experiments. We never really, but just a bunch of prototypes. We never launched anything publicly on top of those protocols. But one of the spaces that we identified was kind of like fast forward. If you fast forward a couple years and like imagine what a world with Ethereum launched and with this concept of decentralized applications actually existing might look like, one of the sort of missing pieces that stood out to us was this idea of like sort of user access control or data privacy. So not necessarily like transactional privacy like a Zcash or
of course,
a Monero type of thing, which is also very obvious. But like if you have decentralized applications, which could be any kind of application, presumably they might need access to some kind of user data, and presumably some of that user data might not be something that you want to be fully public in clear text on a public blockchain or some public file system like IPFS. And so the idea for NuCypher was, okay, we can use some of this novel like threshold cryptography to add like a layer of privacy and access control on top of this data to enable sort of this broader range of use cases to actually handle private or confidential data. And so that was the genesis of NuCypher. We were building something called threshold proxy re-encryption for the initial iteration of the network. And basically it just allowed users to conditionally grant and revoke access to their data. So like a very like illustrative example that's easy to understand, probably not like the best practical use case for DF, but like let's say someone wanted to build like an electronic health record system on top of like IPFS. They could use NuCypher and proxy encryption to encrypt their data before it gets uploaded, but then still selectively grant access to that encrypted data to like their healthcare provider, their insurance provider, their doctor, et cetera. And that was sort of the idea. We launched that network, launched on Mainnet in 2020 as a NuCypher network. And then I think it was like about a year or year and a half later, NuCypher combined with another very similar threshold cryptography network called Keep Network and formed Threshold. So Threshold is basically like the amalgamation of those two existing networks. And it just combined everything into one token. So if you had the new token or the Keep token, you could upgrade that to T, which is like the governance and staking token for Threshold. Combined all the node operators, basically all the use cases, all the applications into one network. And that's the network that we have today. The sort of the latest iteration of proxy re-encryption is now using, it's no longer proxy re-encryption that runs on Threshold, it's threshold decryption, which offers a little bit more flexibility. So based off of a lot of the use case explorations we were doing with adopters, they preferred sort of this more flexibility than proxy re-encryption could grant. So like now it's just threshold decryption. And then the other sort of major use case and application on top of Threshold is something called tBTC, which I'm sure we'll probably get into a lot on this talk.
Yeah, for sure. It just as a random side observation, I do notice that a lot of my favorite projects tend to use threshold signatures. So whenever I hear that, it does seem to be a kind of a warning sign or whatever alarm bell of like, oh, pay attention to this. I remember in the very kind of early days when Dash was doing its instant transaction, other functionality, they started using threshold signature aggregation. And then, of course, it's a big hallmark of Thorchain and the Maya protocol and all those cross-chain dexes. And then Vultisig, the new wallet that's launched by the Thorchain team that does threshold signatures, for key sharing and things. just every cool thing seems to have that involved in some way. So, especially because like the vault kind of technology of Thorchain and its Thor children does seem to be pretty robust now, and especially when you go to some kind of bridging thing, it does. That's what made me think, oh, I'm going to pay attention to this as opposed to all the other things out there. Yeah. So why don't you get into then? Well, first, Threshold, right? It this is where we get into a lot of the weeds of the modern space, where there's so many different projects doing so many different nuanced things. So it's not an L1, correct?
Correct. So Threshold technically runs on top of Ethereum, but I mean the coupling there is pretty loose. So basically, it uses Ethereum for staking and for consensus. So if you want to run one of these Threshold decryption nodes or one of the tBTC nodes and participate in the network, you have to stake the T token, like a bond, and that lives on Ethereum.
On Ethereum mainnet, correct?
Correct, on Ethereum mainnet. But and then it uses like tBTC uses Ethereum for like accounting to track like the balances of tBTC that gets issued. But the coupling there is relatively light. I mean, theoretically, like this could live on another chain or its own app chain potentially.
Yeah.
And tBTC itself exists on many chains, not just ETH1. So this exists on most of the major EVML2s today. It exists on Solana, and probably like in the Cosmos ecosystem relatively soon as well.
Yeah. So let's just dive into tBTC now. So, real quick, what is it?
So tBTC is both a decentralized permissionless Bitcoin bridge and a synthetic Bitcoin asset that is collateralized by Bitcoin deposits, one-to-one. So I'm sure you're familiar, and most of your viewers are probably familiar with this concept of WBTC, or wrapped Bitcoin, which is essentially like a tokenized IOU or receipt of Bitcoin that obviously lives on the Bitcoin blockchain. But the way that it works is you send your Bitcoin to some custodian. In the case of WBTC, it's BitGo. They issue you a tokenized representation of that Bitcoin that they're custodying on the Ethereum blockchain or whatever other blockchains that they might support. And you can use that tokenized representation to participate in DeFi. So you can deposit it into an AMM to do LPing. You can lend it out to earn a yield. You can borrow against it, to pull out cash without selling your Bitcoin in a protocol like Aave or Compound. And that's effectively what tBTC is as well, in terms of use case. But tBTC replaces that single centralized custodian with a network of signers that are collectively custodying that Bitcoin. So rather than a single custodian, or I think now it's just 3 custodians with WBTC, as of a couple months ago, Threshold or tBTC pulls from the set of Threshold stakers, and those Threshold stakers collectively custody that Bitcoin using a combination of Threshold signatures and something called distributed key generation. So you're not having to rely or trust like this single centralized entity, both to securely and safely custody the Bitcoin, but also to like do things like honor redemptions and things like that. So tBTC is both the asset, where it's custodied, the underlying is custodied in a decentralized way, and as well as a bridge. So with WBTC, you have to go through like a permissioned merchant, and if you and I aren't going to have like an account with most of these merchants. It's primarily just institutions that have the ability to mint and redeem Bitcoin. Whereas with tBTC, it's permissionless, so you just go to the Threshold dashboard. You can deposit Bitcoin. You can burn tBTC to redeem Bitcoin, without having to like create an account and onboard with some sort of merchant or centralized entity.
Yeah. So obviously, a lot of that is pretty, kind of. I have a pretty good grasp on that so far, but to sort of dumb it down a little bit, if you have So let's just say I'm going to play maybe boomer Bitcoiner advocate for a second, right? So imagine you're some old school. And by the way, just yesterday I was helping a man in his late 60s, early 70s try to sell some of his Bitcoin so he could go on vacation. So I do deal with a lot of this may or may not be a real person, right? So as far as they know Bitcoin, they trust it. They just learn to not trust custodians, that they shouldn't trust a exchange because an exchange rugged them, or start asking too many questions about where it came from, and they got soured on that. But then also using Bitcoin itself on the main layer is just the price is way too unpredictable, whatever reason they want to be able to use it in a more efficient way. So then someone like me, they're not young, definitely, but younger, like nerdy friend, tells them, hey, well, have you heard about this threshold thing? Why don't you try tBTC and use that instead? And so they ask, let's just say, well, so where does it go when I put it into the machine? I go there and I send it. So where does it go?
Yep. So where it goes is when you deposit into Threshold using tBTC, I think it's every other week. What happens is a bunch of the Threshold stakers basically come together and they participate in something called a distributed key generation, or a DKG. And this is like a fancy way of saying that these stakers collectively generate a Bitcoin address on the Bitcoin blockchain. And that's where the Bitcoin gets deposited. And so no single one of those stakers can sign a transaction to move that Bitcoin by themselves. It requires a quorum of those stakers. So currently, the wallets that are generated are 51 of 100 signer sets. So as long as a majority of those stakers agree to sign a transaction, then they can move the Bitcoin. And the reason, like, a valid moving of that Bitcoin would be if someone requests a redemption. So they have tBTC and they want to go back to native Bitcoin. And they burn that tBTC on the Ethereum blockchain, and they provide that proof to the network. And those signers say, okay, this looks legit. They sign it, and then the user can withdraw back to native Bitcoin. Basically, that's, there's a few like internal, movements within the system where the Bitcoin might get moved, but basically, like, the only legitimate movement of that Bitcoin is to redeem back to a legitimate user. Basically, they shouldn't be moving the Bitcoin for any other reason. And so all this Bitcoin gets deposited into a Bitcoin address that's collectively basically custodied by these 51 of 100 signers. Whereas with a centralized version of that, one entity would generate an address. They would deposit that Bitcoin with that entity, and that entity can unilaterally move that Bitcoin. And presumably, that entity hopefully is incentivized not to do that for like reputational reasons, legal reasons, et cetera. But the idea of tBTC is like I think in the crypto ethos generally is like we don't want to have to rely on like centralized
trusting people,
trust in entities, or like the legal process to secure assets. We want to rely on something that is sort of more sovereign and hopefully more robust in the long term than that.
Yeah. So 51%. What's to prevent 51% of people of these nodes from just deciding they'd rather just like steal the money?
So basically, this is actually the V2 of tBTC. So the first version of tBTC, tBTC V1, ran on the old Keep network, which was one that, along with NuCypher, was what formed Threshold. And tBTC V1 worked a little bit differently. It required signers to basically over-collateralize all the Bitcoin that they custodied with ETH. So I think it was they had to deposit, the signers had to deposit 150% worth of ETH for every Bitcoin that they custodied. And so and then if something happened, if like they moved that Bitcoin incorrectly, that ETH would get seized by the system and would basically buy back Bitcoin to basically fill the loss. And that was something called an economically secured bridge, because you over-collateralize with some exogenous asset, in this case ETH. The problem was that this basically was not scalable at all. Like you can imagine, like there's very little reason for a signer to want to deposit 150% of ETH to add minting capacity to the network when they can get they can stake that ETH and get yield. So very quickly, this is like, I think in tBTC v1 wasn't the only version of this. There was also a project called Intralay on, I think it was Polkadot. Basically, it very quickly proved out that like you couldn't scale these systems to like any really meaningful amount. They quickly capped out capacity, and if you have really low supply, like you're not going to have a useful asset like Aave, Compound, lending protocols aren't going to onboard this. You just really can't do much with it. So that was kind of the incentive or the impetus to move to this tBTC v2, where it got rid of this over-collateralization requirement entirely in favor of an honest majority assumption. And so that's like basically that's how the v2 was designed. But in the interim, it uses this, there's this beta staker program, which is essentially like a DAO approved whitelist or subset. So currently, when tBTC generates a new deposit address, it doesn't pull from the entire set of threshold stakers. It pulls from a smaller set who have been approved by the DAO, who are basically like doxed to the DAO. They're relatively known entities. They have made certain like social commitments in terms of uptime and liveness, so that we can bootstrap the system. And basically just, you don't want to launch a fully permissionless signer system from day one and put a bunch of Bitcoin in it. To your point, you want to, because anyone can buy a bunch of T, stake it, try to Sybil attack the network. And so we wanted this sort of bootstrap period where we could make sure everything is working as expected. We could have very responsive signers in case one goes down. They're committing to upgrades in a very timely manner. So right now, it's an honest majority assumption across this subset of stakers called the beta staker set. And I think that's like 35 entities have been added to that right now. It's a mix of like professional stakers, some of the contributors, community members, etc. That's how the system is now. I think the end game for the system is actually in the last couple of months. I think previously, like the Bitcoin bridge design space viewed the honest majority assumption as like sort of the best that you could do. But fortunately, in the last couple of months, there's been some really, I think, like orders of magnitude improvements in terms of Bitcoin designs. None of these have launched yet, but the most interesting one that is possible on Bitcoin without any changes to Bitcoin, whether it's a soft or hard fork, is something called BitVM2. And theoretically, using that design, or not theoretically, like we know it's possible, you can go from an honest majority assumption to a 1 of n honesty assumption. So as long as you have one participant in the system that's rational and honest, that Bitcoin is safe and secure. So I think that's like either BitVM2 or if Bitcoin introduces like opcos from like CAD or CTV or something, like that's like the end game for tBTC. And obviously, like going from honest majority to 1 of n is massive. Like that's basically like essentially the same security guarantees you get with a real EVM L2, where there's not a multi-sig on that. So I think like that's like the long-term goal, certainly for tBTC, and I think where we'll end up. But certainly, like fundamentally, like holding Bitcoin on the Bitcoin blockchain in like cold storage is always going to be the most secure thing. And there's some subset of Bitcoin holders that are going to do that. And I know to some degree I certainly sympathize with that. Like I understand. And anything you do with that Bitcoin, whether you move it into a Bitcoin L2, whether you move it into WBTC and custody it with BitGo, whether you deposit it into like, some like Celsius or some of these last cycle places that blew up, by definition, like you're introducing some additional layer of risk. I think in the long term, like, once these BitVM2 1 of n systems have run in production and people are confident in like their implementations and they have Lindy, like that's like I would feel very comfortable. I think most of the all but like the most hardcore Bitcoin maximalists would feel very comfortable using those systems. But by definition, you're introducing some additional layers of risk. And obviously our job at tBTC and our goal at tBTC is to like minimize those risks as much as possible, so that people can feel confident deploying their Bitcoin into either L2s or onto Ethereum, and then being able to participate in DeFi and actually earn yield or borrow against their Bitcoin without having to sell it.
Yeah, and so the nodes, the validators that run this, I'm sure they have to stake T, right, or the threshold token.
Correct.
And so there's a certain minimum anti-Sybil threshold for running one of these. And obviously, you already mentioned that we're in a transition phase right now where it's kind of it's not just anyone. But assuming we move on to like a threshold V2, where now it could be anyone. So they have a certain amount they have to stake to even participate. And is there any sort of a slashing element where if they do perform maliciously, then they could like lose that initial investment?
Yes, there is slashing. So if a node or signer misbehaves, and it couldn't also just be, it's not just like signing a transaction that they shouldn't have signed. It could just be they're not online. That's also not great because we need these nodes to be online to participate in the DKGs and to sign transactions. So they can be slashed for either misbehavior, like signing something they shouldn't have signed, or just liveness, like not being online when they should be online. But the major difference between V2 and V1 of tBTC is they can get slashed, kicked out of the network. They won't be selected for future wallets. But like that T is not over-collateralizing the Bitcoin deposits in the system. So right now, I believe, I haven't looked today, but I think there's like roughly like $500 million worth of Bitcoin deposited into Threshold and tBTC. Certainly like by design, there's nowhere near that amount of T staked. So it's not meant to be like an over-collateralization of the deposited Bitcoin. It's meant to be like a selection mechanism for who gets picked as signers in the network. Yeah,
that makes sense. And so with node profitability, I assume there's like a fee mechanism in there. How does the fee mechanism work? Is it just for minting and redemptions, or how basically what's the profitability mechanism for the network?
Sure. So for the network, you're right. It charges basically fees on minting, basically when you cross the bridge, so when you mint tBTC or when you redeem back to native Bitcoin. Currently, the mint fee is actually 0%, because we're trying to grow TVL and the utility of the asset. And then I believe that redemptions are currently 0.2%. So if you want to redeem back to native Bitcoin, the network charges a small fee to do that.
Yeah, and at some point it would be probably a similar fee both ways, right? Just obviously not a commitment to those numbers, but just the general idea is something like that.
Yeah, I mean, potentially, like that's within like the discretion of the DAO. So token holders ultimately vote on what the fee is. I think that there's obviously like some also like sort of just natural like market mechanisms to like control the range of like a valid fee, because let's like the most extreme, you just jack the fee up to like 10%. Like that's obviously not going to work, because the more you increase the fee, you also sort of like very directly impact the peg of the price peg. Because let's say if you have a 10% fee, like presumably tBTC is going to trade at like a 10% discount to native Bitcoin, because people that are doing arbitrage basically have to account for that fee. So like I think there's a natural fee range, which is relatively small, where I think it's viable to have this to set that fee.
Yeah, and of course, I mean, from just my quick estimation, it seems like the price of tBTC should be, if it's directly redeemable for real Bitcoin at any time, and the market trusts that, then it should be the price of Bitcoin minus whatever fees plus whatever the value of the utility is that you could get from tBTC. So even if there would be relatively high fees, which I understand is not the plan, if people can do really cool, awesome things with it on the other end of it, if the utility is so much better, then you might even see a premium, even if the fees are high.
Yeah, I mean, like, yeah, well, as long as the mint fee is 0%, you're probably not going to have a premium for very long,
Hmm.
because obviously there's a natural incentive for people to arbitrage that and mint
Yeah,
more
of
to
course.
using their Bitcoin and sell it. But yeah, I think if you look at the price history of tBTC, particularly since redemptions were turned on a couple years ago, like the peg has been very very good. Um, and obviously, like if someone sells a huge chunk of tBTC on like a DEX without like looking at slippage and considering slippage, like they could there could be like a small period of time where like the price isn't exactly, but like obviously like there's, as you said, there's a huge, very immediate way to for the market to correct that by incentivizing people to come in, buy back up tBTC and redeem it for Bitcoin. So the peg has performed very well, particularly since redemptions were turned on.
Yeah, and that's one of those things that obviously I've I had a little bit of UST during the Terra Luna thing. So I didn't lose anything that like screwed me over, but a little bit. And just watching those kinds of mechanics kind of interesting, where supposedly all that Bitcoin reserve they had was supposed to provide to be like an anti-crash mechanism, but because you could not redeem it, the user couldn't redeem it, then it was just free fall at some point, especially when shenanigans started to happen as well. So having that redeemability aspect is definitely, because anytime you want to mess with, you're trusting custodians is one, and then you're trusting a network to peg a value of some kind. It's the depegging is the I mean, hacks I'm sure are huge a fear of the space in that case, but depegging is probably almost as big, where you just want to make sure it's going to not depeg, and being able to just actively realistically redeem for one-to-one Bitcoin. I think is something that really says a lot to being able to trust the system.
Yeah, I mean, I think the permissionless mint and redeem obviously like gives you access to basically like the not unlimited, but essentially unlimited liquidity of actual native Bitcoin. But even that, like I think like if tBTC liquidity on smart contract chains, Ethereum, various L2s has grown very robustly. So even like it's improved like even without having to have the backstop of redemptions, obviously, which will always be there, of course.
Yeah, for sure. It's available to be minted on most EVM chains, I would assume. You mentioned Solana as well, and so it's EVM,
Yeah.
SVM, what else, and then
Yeah. So
Cosmos, right?
right now, you can mint to Ethereum L1. I think it was like 2 months ago, Threshold added the ability to directly mint to Arbitrum. I believe Base and some of the OP stack is probably next. Um, Solana is also in the works. So right now, the way that it works, if you want to move to Solana or some other chain without direct minting, you need to mint to Ethereum L1 first, and then bridge again through Wormhole to that other chain. But obviously, like we're very interested in adding direct minting to all the supported chains as soon as we can, so that people don't have to do this sort of pit stop in Ethereum.
Yeah, and so that's kind of the way it's kind of envisioned is you go to the site, you connect the wallet, you decide you're gonna mint, you send some Bitcoin in there, and then I'm sure there's a certain confirmation threshold before you'd want to get like number of confirmations before it's considered secure. So maybe you wait a couple hours, depends on what Bitcoin's doing that day,
Yeah.
and then you just get tokens created tBTC on whatever chain you specified, and then you're kind of off to the races then, right?
Yep, exactly. So you go to dashboard.threshold.network, like the mint tBTC pane, connect wallet, select, whatever the destination chain is that you want. You ultimately want that tBTC to be delivered to, and then you deposit your Bitcoin to the address that's just generated there. And then that will get minted by the network. Usually, it takes about 2 to 3 hours. There's some slightly more complicated logic, like depending on the size of the mint, like the network might require a few more confirmations than for a small mint, for example, just to protect the integrity of the system. but yes, that's exactly how it currently works today for Ethereum and for Arbitrum, and very soon for most other networks.
Yeah, so redemption, you'd go kind of a similar process, and then you'd basically burn the tokens, and I assume that it'd probably be a lot faster to redeem than it would be to deposit, right? Because you would just, as soon as the tokens are destroyed, then the system spits out some Bitcoin at you, right?
It actually is about, it's a little bit longer for redemptions, because obviously like the network needs to, so first it needs to basically collect a sufficient number of signatures from, a majority of the nodes to move the Bitcoin. And then obviously, we want to make sure that like a redemption request, the network needs to basically be very sure that a network request is valid, to avoid basically like, some catastrophic attack of somehow tricking the network into basically doing a bunch of redemptions that it shouldn't have done, which would obviously like if you, like in the very worst case, drain TVL or something. So usually I think it's about 2 to 3 hours on average for a mint, and maybe like 3 to 4 for a redemption. But again, can vary based off of a couple things, like including the size of the mint or the redemption, and then also how busy the Bitcoin network is, how long those confirmations take. In some cases, like if there's a bunch of redemptions or requests at one time, those need to be queued for the nodes to sign those transactions.
Yeah, no, it makes sense. And so, first of all, what was the primary, I guess, intended customer use case when designing a system like this? Like from the initial perspective, right? I'm thinking about L2s for Bitcoin. Typically, the first thing they're trying to do is just be able to send and receive the dang thing that doesn't cost an arm and a leg and take forever. And so obviously that's something that can, from like my perspective, it's like, oh, you can actually pay with Bitcoin and it doesn't cost a bunch. You don't have to trust custodians. But I'm sure with the whole DeFi world and everything else, like wrapped Bitcoin on Ethereum, definitely that's not a use case that was envisioned really, or it wasn't a very common one. It's just more, how do you do like lending and other DeFi type things? So who are the main people who are dying to be using this, do you think?
Yeah, so there's two sides. There's one, people who want to earn yield on their Bitcoin, and they could do that by bridging and then like LPing on a DEX, for example, and they can LP in a stable pair like tBTC, wBTC, or cBTC, or some other Bitcoin asset if they want basically to have full exposure to Bitcoin price, or they can pair with ETH or with a stable coin or something, which you need to like think about in permanent loss and things like that if you're going to do that, but might pay like a higher yield. So that's one, and you can also lend it out to earn yield. So lend your Bitcoin out to people who want to borrow it and pay an interest rate to do that. The other one is people who want to borrow against their Bitcoin, so use it as collateral to pull money out. So this could be stables, it could be like USDC, which you proceed to redeem for actual dollars that you can withdraw to your bank account to like buy a house or do whatever you want to do. But they want to maintain ultimately like the long exposure to the underlying Bitcoin, because the alternative is you just sell your Bitcoin and then you no longer have exposure to it. But a lot of Bitcoin holders naturally don't want to sell their Bitcoin. So this is a way for them to get dollars out without selling, and in a more trust minimized way than say borrowing from some centralized entity who might then proceed to rehypothecate that Bitcoin and like lend that collateral out to like a hedge fund and blow up like we saw last cycle.
Or hopefully that we won't see this cycle. I don't know. Some of the MicroStrategy is creeping me out.
I think DeFi performed, like the real DeFi performed very well during that last cycle where a lot of the CeFi stuff blew up, and so I think that was a great iteration for a great cycle for DeFi to sort of prove itself. And we have a lot of very robust primitives that have been around through like a full cycle or more. So I think for the people who, I think people should, hopefully have a lot more confidence in these DeFi protocols, in my opinion, over sort of the other centralized alternatives. So that's sort of those are the main use cases. And then tBTC specifically, like for the first couple years of tBTC, it was very popular as like a bridge. So people would mint tBTC, and then what the behavior we saw is that they would often like swap that tBTC after it was minted into WBTC. And really the reason why is because WBTC was just so entrenched in DeFi. They were, very early. They were onboarded with all of the DeFi protocols. There was tons of on-chain liquidity, so like very easy compared to tBTC historically to like borrow against that against WBTC or do whatever other things you want to do with WBTC. So we had because it was permissionless, the bridge velocity was actually very, very high compared to WBTC. I think I looked earlier this year, and at the time tBTC TVL was 200 million and WBTC TVL was 10 billion. And the actual amount of Bitcoin going back and forth across the tBTC bridge relative to the WBTC, we'll call it bridge for this purpose, although it's not quite a bridge because you have to go through these permission merchants, was very close. So on multiple orders of magnitude less TVL, the bridge velocity of tBTC was very close to WBTC. But what's happened really since this summer is tBTC as an asset has really hit an inflection point and started to grow TVL because the amount of things you can do with tBTC has really started to increase. So it's been onboarded into a lot more blue chip protocols. Like you can borrow against it on Aave and Compound. There's just tons of more things you can do with it. A lot of these new Bitcoin L2s have started to onboard it as an asset as well. So I think we've started to see obviously the historical strength of tBTC as a bridge, but also now people just staying in tBTC rather than swapping into some other asset.
Yeah, I guess it is kind of a powerful sign when you start to see it being used as highly preferential for getting to the other asset, the WBTC. And then at some point when there's a tipping point, you start to just not who would go through the annoying bridging process to WBTC if they could just do a better one and do all the same things.
Yeah, I think we're starting to see that sort of prove itself out in the market. And certainly if you fast forward 5-10 years, I don't think there's, particularly if we have these BIFEM2 or similar one event honesty assumptions for tBTC and other Bitcoin L2s, and those are Lindy and have run for many years without any issue. I basically think there's zero likelihood that people are going to be parking meaningful assets in the centralized alternatives, because you can have a one event assumption on a proven system where the main risk is a smart contract risk. But if it's run for 10 years on huge amounts of TVL, you can feel very, very confident in that, versus the centralized custodian risk, or in the case of some of these assets, I believe CBTC has WBTC has blacklisting for the entire thing, which seems unlikely that they would do. But some of these newer assets like CBBTC have individual address level blacklisting. You're exposed to that and exposed to the custody risk. I don't think there's any way that people over the long term are going to prefer these centralized systems over a proven one event system.
Yeah, that's for sure. So Bitcoin is obviously the one that really starts the show. Are there any other kinds of assets that you could easily see people wanting to do a similar setup where you use the Threshold network to secure it and into representation?
In theory, you can create a version of tBTC for Litecoin, I think Zcash, Monero. There's been a lot of those, and people have asked for Doge.
Of course.
I think so in theory that's possible from a technical perspective. I think that just the challenge is you need to think about really how much actual demand is there for wrapped versions of these assets, because it's been quite difficult to like grow liquidity in TVL for tBTC as an asset. We started to see some significant success with that over the last 6 months or so. But I think it's just it needs to, we would need to be like, I think we or whoever would launch like a version of these other wrapped assets we need to have a high degree of confidence that there's like a sufficient amount of demand, because it's quite difficult to spin up these networks. The tech is the threshold signature. Threshold signatures, DKGs are like very thorny cryptography. Not particularly cheap to operate these bridges. So I think you just need to, like, from a practical standpoint, I think you would need to sort of think very carefully about like what assets make sense. But yeah, in theory, it's possible to extend this model to other assets that are similar to Bitcoin.
Yeah. Now, what about stable coins? I know that algo stables and stuff, or over-collateralized stables, are all the rage these days. And it seems like stable coins are kind of where mass adoption for payments is going to at least start at. So
Yep.
I'm sure you guys have looked into that.
Yes, I mean that's one of the big use cases for tBTC is to mint stables. So right now you can use it to mint CRV USD. There's also THUSD, which is sort of a native stablecoin launched by Threshold Network community members. That's a fork of Liquidity, but instead of ETH as collateral, it uses obviously tBTC. I think there's the high stable coin on, I believe it's Optimism or one of the EVML2s. So several options to mint stables, which is effectively like another version of borrowing against your Bitcoin. So you can you basically deposit into CDP, mint these stables, and then you can convert those to USDC, get fiat out, or you can just use those stables if you want to create a leveraged long position on Bitcoin. You can use those stables to buy more tBTC, mint more stables, and buy more, and sort of do this looping strategy that some of the more people that have more aggressive views on where the Bitcoin price is going might want to.
Yeah, the threshold sailor, let's just say. Yeah.
Yeah. I'm sure. I mean, I know for a fact that there are people using tBTC and WBTC and cBTC to do pretty extreme leverage versions of decentralized leverage versions of what Sailor is trying to do or is doing.
Yeah, for sure. What are some of the other big things you're planning on doing for the future now that like tBTC is a solid thing? It's it's working. And you have some other, some stablecoin type things. What are some other things you're kind of thinking on towards the future?
Yeah, I mean, I think the major priorities for tBTC are direct minting. So adding support for not just ETH-L1 and Arbitrum, Base, Optimism, some of the Bitcoin L2s like Bob and Mezzo, Solana. Basically, everywhere where tBTC is, we want to have direct minting because that's just a much better user experience, and direct redemptions eventually as well. So that's the big one. The other big one is, of course, continuing to figure out the best way to implement the BitVM2 one of n assumption, because that's just a massive step change in the security of the network. Moving from honest majority to one of n honesty assumption is very significant, and ultimately, I think the end game for not just tBTC, but basically all many of the Bitcoin L2s and any other sort of Bitcoin bridges that people might launch in the future. And so basically we just want tBTC to be, and of course, adding utility to tBTC as an asset by getting it integrated into more and more DeFi protocols so that people have tons of options on what to do with that, whether it's LPing to get yield, lending it out to get yield, borrowing against it, both on ETH-L1 and all the L2s and other chains where tBTC lives. So there's sort of very broadly, there's two areas of priority. One is just making the custody model and the security of tBTC as robust as possible, so that people can feel very confident depositing large amounts of Bitcoin into the system, and it will remain secure. And then also making it the user experience very good. So you can seamlessly deploy across whatever chain that you want to deploy it to, and into any DeFi protocol that you want to do it, whether it's earn yield or to borrow.
Yeah, that makes sense. All right, cool. This has been a very fascinating chat. Where would you direct people to find out more about tBTC or Threshold, as well as follow you personally?
Sure. So if you want to mint or redeem tBTC, it's dashboard.threshold.network. And of course, you can find a lot more information about tBTC and Threshold Network more generally there as well. If you want to learn more about like the underlying architecture of the network, docs.threshold.network is a good place to start. On Twitter, it's at the T Network, and my personal Twitter account, although I'm more of a consumer than a producer on Twitter, is my name, at MacLane Wilkison.
Yeah, perfect. Well, thanks very much for being on. I'm sure this will be very fascinating for a lot of people. And yeah, everyone, thanks for watching.